Hi everyone. This week I'll highlight cap rate trends and how some investors are getting caught in the details that can distract them from the big picture. There's a bit of a buyer and seller disconnect and some ill-conceived notions that are getting in the way of their accomplishing their investment goals. So to get started, I'm going to talk a little bit about what's happening with cap rates. At a macro level, cap rates have been stable since 2016. The blended average for all commercial real estate is about 6.3%, and that's down from a height of 8.2% in the wake of the recession. Overall, they've been really stable for the last 2.5 years, but one of the issues that we're running into these days is a disconnect between what buyer and seller expectations are for pricing. So in a way, this expectation gap is understandable. From a seller's perspective, vacancy rates are low and very stable. Rent growth is positive and steady. The economic outlook is still good. And in many cases, sellers don't feel a lot of pressure to sell today. But what they really need to be thinking about is their portfolio, and whether or not it's properly diversified, whether they're maximizing the yield on the capital they have invested, and perhaps taking some chips off the table considering how strongly the market has performed over the last 8-9 years. Really, they have to be thinking about where do they want to be over the next cycle and how the sale of an individual asset fits into that bigger picture. Of course, they always want to get the maximum amount they can in the sale of a property, but they can't take their eyes off the ball when it comes to their longer term objectives. Now, buyers are a little bit more cautious. I go to conferences on a regular basis and I talk to investors, and the buyer's perspective is always that prices are too high. And I think anytime you talk to buyers, the prices are always too high. But you really kind of have to look at where are we, what are the prices, and where do we want to be in 5 years or 10 years down the road? Not so much what is the price of this asset per se. Economic risk and the potential for a downturn are certainly out there, but interest rates are very low right now, so the cost of capital is very good. Buyers really need to be thinking about, does this property fit my investment objectives? Does the yield satisfy my needs? How does this compare to other alternatives that I could invest in? And if I put my money to work today, am I better off than generating a minimal yield for a year or 2 years or 3 years while I wait for prices to go down or some sort of correction? Now, what should investors be watching? The interest rates are down, cap rates are basically flat. It's a great time for a portfolio review, looking at diversification and risk, the leverage, and the opportunities there may be out there to boost yields. So don't lose sight of the big picture, quibbling over the small pieces, and look at your 5-year horizon to determine if an investment makes sense, whether you're buying or selling.